So John, welcome to ABC Bullion. It's early September, so we're the better part of 2/3 of the way through the year. It's obviously been a fairly tumultuous year, rates rising, markets pretty volatile, etc. Given everything that's taken place, how do you think gold has performed so far across the course of 2022?
Well, to be frank, it's probably performed better than I would have expected coming into the start of the year. We knew that the Fed was going to hike. Perhaps didn't expect the dollar to be as strong as it's been. Certainly didn't expect Russia to invade Ukraine. So the first half of the year, I think gold did better than I would have expected. And obviously, we've seen the second half of the year so far. We've seen gold under pressure, particularly as the dollar's been so strong and as interest rates, particularly real US interest rates, have risen.
Okay, fair enough. And look, I guess, on a relative basis, certainly when you compare it to equities, long end of the bond market, crypto, obviously, which some people love comparing gold to, and we can talk about that a little. On a relative basis, gold's done pretty well, even in US dollars, done very well in other currencies. Yeah. But I guess from a sort of a headline level, everyone always kind of links gold and inflation together. Inflation levels are obviously very problematic, and we'll talk about that a little bit more. Sure. But why has gold not done better, playing devil's advocate, given where inflation levels are?
Well, I think work we've done shows that, surprisingly, gold isn't actually very correlated to US CPI inflation.
Right.
It's much better correlated to other broader measures of inflation, particularly US money supply growth. And if you think about the last couple of years, we saw an extraordinary expansion of the money supply in the US as a response to the COVID pandemic. And gold indeed performed really well in 2020. Since then, money supply growth has slowed and even begun to roll over now. And particularly as the Fed is going to be engaging in a bit of quantitative tightening as well as hiking interest rates as well, that may be one of the factors that has stopped gold performing with high inflation now. In a way, you actually got your inflation protection before inflation came along itself.
So it's almost like gold reacted before the official CPI numbers reacted.
Sure,
as it were.
An anticipation that everything that was being done by central banks and governments to fight the recession that was coming from the COVID lockdowns, that was the inflation reaction then. So it anticipates it. And if you think about it, if you think what's really moved in the last 12 months or so, it's much more like being industrial commodity stuff that needs to be used rather than the hedges against inflation.
Yeah, I think it's a really interesting point. It's almost like if you need to wait for the official statistician to tell you that there's inflation, the insurance against it has already moved up in price as well.
Exactly. You've probably missed it in gold.
Yeah, that's a great point. And so sort of just staying on this topic now, I mean, here in Australia, headline CPI rates have now sort of pushed north of 6%. The RBA thinks that they'll be closer to 7.5% by the end of the year, but then probably start to ease off next year. It's problematic here, but it's a whole new level of pain in Europe and indeed in the UK, where you reside. I think the official inflation numbers are now more than 10% in the
I think they're
UK.
I think they're just south.
Yeah.
Although to be frank, it's so horrific, I've stopped looking.
Yeah, right. And the private sector is saying 18 to 20%.
Yeah, I think I saw Goldman Sachs say 23% early next year.
That's incredible.
It absolutely is. Now, I'm old enough to remember high inflation the last time around, but this has come as a real surprise. It's also interesting what's been driving inflation in different markets. There's a lot of financial market attention paid to the US economy, which makes sense. I mean, it's certainly the biggest free world economy or developed market economy out there, and we wait with bated breath for everything that Chairman Powell says or for the exact number of jobs created each month of non-farm payrolls. And there's actually, I'd say, a fair amount of optimism about how things are working out in the US at the moment. Yeah, inflation's high. But it might have topped and be beginning to come down a bit. And certainly gasoline prices have fallen quite a lot. So there's almost if I listen to the commentators coming out of the States, it's like, yeah, things are bad, but they're going to get better soon. And in fact, we might have seen the first signs of that.
And job market's still pretty strong. And so there's sort of
absolutely
optimism in that regard.
Yeah, and I think there's a view that there'll be a slowdown. It might be a brief recession. But then we'll be back, we can go back to buying equities again, which is what we've been doing for the last 20 years.
Yep.
Europe, on the other hand, though, feels dire. And I tweeted something out a couple of weeks ago. It said, I cannot remember when things felt as bad as they do in the UK at the moment.
So that's an interesting question, because there's obviously the story that the data says or suggests, but how people actually feel is just as important, because that's going to drive their household spending decisions and is inflation now kind of, for want of a better term, like the barbecue talk now? Is that what, is kind of everyone worried about it in the UK now? Everyone's talking about it?
Very much so. And they term it slightly differently in the UK. They call it the cost of living. So the cost of living squeeze, and particularly what's going to happen to electricity prices and natural gas prices is the topic everywhere. I don't think people have realised quite how much interest rates may have to go up.
Right.
As well. So we've seen a big move in mortgage rates in the UK, but most people are on fixed deals between 2 years and 5 years, so they're not seeing that feed through into their back pockets yet. But they are seeing the energy price increases coming through.
Yep.
And we're getting pretty stark warnings coming from governments, from commentators, about how we may actually have energy blackouts this winter if we don't have enough gas to run the power stations. And almost every day you're hearing industrial companies shutting down because they can't make money. There's a fertilizer plant in the UK which supplies I think it's half of our fertilizer requirements, and they've stopped producing.
Right.
Because it's a very energy intensive process. And one of the really scary things about that is that carbon dioxide is a big secondary product from there, and without carbon dioxide we won't have a beer industry.
Sure. No beer in England.
We're in England, but the other thing is as well is there was a projection made by the pub association saying that 70% of pubs won't survive the winter.
That's politically untenable, surely.
Well, I think pubs are bad, but I'm genuinely concerned that with these energy prices, there'll be a lot of people that just won't turn the heating on, and we'll probably get tens of thousands of deaths this winter. It's
a real tragedy. Because correct me if I'm wrong as well over there. So household energy bills are capped, or there's like a degree of regulation there. But for SMEs and the like, that's not the case. Am I oversimplifying it? Maybe?
No, you're quite right. So we know what the maximum tariff rate, per megawatt, per kilowatt hour or whatever, will be on a 3-month basis if you're a household. Although they're now adjusting that every 3 months rather than every 6 months. So. Right. Which I guess is a reflection of the volatility coming through there. But yeah, the SMEs don't have the same degree of protection. And there's been cases coming through of companies saying, well, my energy bill is now going to be 6 times what it was previously. Yeah, wow. And people are simply shutting down operations.
A cafe, a pub, a bakery.
A bakery, exactly.
Right.
Yeah, it's going to be absolutely horrific. So, and it's not just the UK. I mean, we've got specific issues in the UK related to weakness in sterling, and supply chain interruptions because of Brexit, but the whole of Europe's in a very similar position.
So on that note, and without any way wanting to downplay the genuine human cost that is by the sounds of things already being felt, but that is going to be felt in the months to come, from a market's point of view, is there the potential that this bad news now is somewhat priced in? I mean both the euro and sterling. And now basically at 20-year lows versus the dollar. So, kind of how much worse can it get in terms of financial markets? There's clearly some more pain to come in the economy. You got a view on that, on currency?
Yeah, I mean, why would you want to buy the euro or buy sterling at the moment? What would you want to buy in these countries?
It's a tough case to make.
It's a tough case to make. And look, that explains why the dollar, the US dollar, I should say, has been so strong.
Yeah.
If you think about the global reserve currencies, you don't want the euro at the moment. You certainly don't want sterling. The yen, well, they haven't even started thinking about fighting inflation there. I think they still see it as a good thing.
Yeah.
And there's only so much money that you can put into into some of the less liquid currencies like the Aussie or the Canadian dollar, etc. So no, it's just, other than a positioning or a technical squeeze, I think it's very hard to actually make a case for these things at the moment.
Yeah, interesting. And obviously that's, at least in the short term, one of the headwinds for gold, at least in US dollar terms.
Yeah, absolutely.
Look, let's move on from the inflation story and sort of back directly into gold. And talk about the sort of various, I suppose, components of gold demand.
Yeah.
Maybe we'll start with bar and coin demand if we can. And can you sort of talk a little bit through what you guys are seeing there? Maybe go back as well to sort of this entire post-COVID era. But also, sorry, if I could add to it, maybe even stretch the story back a little bit further, because World Gold Council data kind of suggests that the demand picture for gold really changed in a very meaningful way when the GFC hit 15 years ago. Did you want to sort of talk about that a little bit?
Yes, I mean, Western world or developed market bar and coin demand was almost inconsequential on a net basis. Some countries would buy some, others were sort of selling, reducing their holdings up until the GFC. And then the GFC seems to have triggered a shift in the attitudes to gold amongst investors in bars and coins. And we had a big step up there. Northern Europe, Germany particularly, but also Switzerland and the US as well. And
Australia, I'd say.
And Australia and the UK too.
Noticeably.
But in general, smaller markets.
Sure, of course.
But big shifts came through in there, and that was pretty much sustained. Even when the GFC went away and the economies were recovering, albeit slowly from that, we still saw strong levels of bar and coin demand. And then the COVID pandemic, the recession that accompanied that, and I think particularly the fears of inflation coming through, have kept demand strong and probably even strengthened it further. So yeah, bar and coin demand is probably the strongest spot at the moment in the gold market. Now, I've spoken about developed market demand. Emerging market demand has always been more important for bar and coin demand. And that's been generally strong throughout the whole period, but very much affected by market access issues. If your economy was locked down and you couldn't get to the shops to buy gold, obviously that's had impacts. So Chinese gold demand this year is going to be probably down quite a bit because of the continuing and ongoing lockdowns we're seeing.
But it's not like the appetite's not there, it's just the access has been restricted
I think that's right,
for a period of time. Yeah, that makes sense. And so let's switch gears then and talk maybe sort of ETF futures market. Obviously, I think 2020 was the record year for ETFs. Better part of 900 tonnes went into those products. Bit softer since. What are you seeing in that on that score?
Yeah, we saw with the Russian invasion of Ukraine, we saw some strong demand in the first quarter of this year, but that's now reversing, and we've seen pretty steady outflows. Not massive in tonnage terms each month, but they're adding up. And so we are seeing, I think we're still positive year to date, but it's not a large number now, certainly compared to the inflows we saw in the first quarter. In terms of the futures market, we actually saw the net managed money position turn short on a net basis towards the end of July. And
pretty rare, right?
It's pretty rare, yeah. I mean, I guess if I think about the charts that I've got in my presentation pack, which of course not in front of me now, 3 or 4 times it's happened in the last 10, 12 years.
Pretty good buy signal as a general
rule.
And
it can be a pretty good buy signal, particularly if it's being accompanied by decent physical demand coming through. Yeah. So there's a couple of things that I look out for to mark what could be a good buying opportunity. One is the positioning that we see in the futures market, but the other is the appetite in the big physical markets, for example, of India and China, etc.
At the very least, right now, it's sort of saying all that speculative froth that was there maybe a couple of years ago, that's well and truly gone now.
Yeah, it seems to have washed out. I mean, look, I'm also old enough to remember when interest rates were a lot higher in the late 1990s, and we saw net short positions regularly. In fact, most of the time, up until gold bottomed around 2001, the market was net short. Now, I don't think we're necessarily going back to that again, so maybe the signals that we see now are not quite as comparable as the ones we've seen under the very low interest rate environment we've seen in a post-GFC world. So, many things, we're having to adapt a bit at the moment. Inflation's back, interest rates are moving higher. I think there's a bit of recalibration going on in all of our minds about how to read the various signals from the gold market.
Yeah, that makes sense. Now, one element that a lot of people like to conflate with gold or compare to gold of course Bitcoin and crypto, and
Yep.
I would say that's one element of the market that's moved in gold's favour this year. In the huge correction in crypto prices, no one's really comparing these two asset classes anymore, even if some people still try to market them as such. What's your view on, do you think Bitcoin ever really had that much of an impact on gold demands? And perhaps just your thoughts on crypto and Bitcoin more generally?
Yeah, it's difficult to say, to be honest, whether the bull markets that we've seen in crypto over the last 5-10 years have had a big impact on gold demand. They've certainly had a big impact on the questions that I get asked, particularly by journalists.
Yeah.
Less so by investors. Curiosity perhaps from investors is like, do you think? Whereas the questions I get from the journalists is like, well, surely Bitcoin and crypto assets are undermining gold. I'm not convinced that they are, that they have to a major degree. If you think about Bitcoin, you're buying this because you're expecting it to do a couple of 100% a year, or maybe go to the moon.
Correct.
And as much as I think gold can be a great investment, I don't think nobody expects it to do more than 20-30% in a good year. So they really are quite different assets. From our perspective, we're the World Gold Council. It's not credible for me to say, Bitcoin's a fraud, or Bitcoin's going to the moon. It's not what we do.
Yeah.
But the work we've looked at in this area is to try and differentiate between gold and crypto assets, and it's quite easy to differentiate them. There's some similarities, but there's far more things that they don't have in common.
I think that's a really good point, because quite often and quite rightly, we'll talk about gold's ability to diversify a portfolio and look at equity market corrections, or periods where inflation is high, etc.
Sure.
Doesn't mean you're anti-equities. It's just talking about gold's relationship with the two. And I think that's a really good point with crypto, because quite often there ends up people that are very pro-Bitcoin will say, well, you're just anti it because it's competing with gold. It's like, well, that's not really the case. It's more about saying, let's be very clear on the differences between the two, of which there are many. And I think most people probably get that now after the correction we've seen.
Exactly. And if you look at correlations of Bitcoin particularly, I haven't done the work on the other crypto assets to the same degree, but the correlations of Bitcoin with equity markets, the last 18 months has seen those correlations only strengthen.
Correct. Yeah.
So you're just not getting the same diversification benefits in buying Bitcoin or other crypto assets as you get when you get gold. Doesn't mean that Bitcoin can't go up. It can also go down, as we've seen in the last 18 months.
Yeah.
But if you're putting Bitcoin in a portfolio to try and diversify what's in the rest of that portfolio, then you probably need to realize that what you've actually done is you've done the equivalent of adding more high beta equity to that portfolio. And one of the things we say to people is, look, I'm not going to tell you whether you should buy it or not. But what I am going to say, if you've bought it, just recognize you've added risks to your investment portfolio. And more risks in your investment portfolio means more need for diversification, so more gold.
And I think one of the, let's say, for want of a better term, positive thing about crypto and Bitcoin is that, if nothing else, through the way that it's marketed as digital gold, at least it's kind of put gold in a conversation with people that might not have otherwise thought about it. So, I've met a lot of younger investors who, naturally, given the volatility and the potential price growth, they're more inclined towards Bitcoin for now. But you know what? At least they're sort of thinking about gold. At least they've sort of got some exposure to it in their minds that they might not otherwise have had.
Well, I think a lot of people have heard the term fiat currency, which they probably wouldn't have heard 10 years ago.
Yeah, there you go. Yeah. And crypto's partly responsible for that in a good way.
Yeah.
So we can put crypto to the side now, but still sort of on this vein. Look, you've obviously been in the gold markets for a long time. What would you say is the biggest myth or misconception about gold that holds people back from allocating money to it?
How long have you got? No, I guess the one that stands...
Pick one.
Pick one, yeah. The one that stands out to me is probably that gold is a highly volatile asset.
Right, okay, yeah.
And it's true that gold is more volatile than government bonds, but everything's more volatile than government bonds. If you compare it to equity indices, if you compare it to emerging market equity indices,
other commodities.
Well, gold's volatility is less than pretty much any other standalone commodity,
Yep.
And it's in line with those of with equities. So it's not as risky as many people naturally think. And one of the reasons they think this is because journalists and financial market commentators will slip it into the conversation every now and again, and just how volatile and risky gold is when it
Sure.
actually isn't.
And of course, even furthering that, when you think about it in the context of the portfolio, because of the correlation with equities, it's almost like even if gold has similar volatility to the equity markets, combine the two together, you probably get a lower volatility portfolio.
Absolutely, and that's the point about diversification. The diversification benefits of gold come from two things. It's been a source of returns over the long term, not just during the bad times or when inflation is around or markets are crashing, but it's a source of genuine diversification, because adding gold to almost any portfolio over any period over the last 5, 10, 20 years has reduced the volatility of that portfolio as well. So it is one of the best diversifying assets out there, particularly, I should add, now that the correlation between, or the negative correlation between bonds and equities seems to have broken a bit.
Sure.
And
as in both are down big time
both
this year,
are down
right?
big time this year. So how is that 60-40 portfolio working out for you?
I saw something over the weekend. I think 60-40 funds, are, even just in nominal terms alone, are on track for their worst year in 50 years. And then you add in, let's call it 7, 8, 9, 10% inflation across the developed world, the picture's even worse.
Yeah.
So on the flip side then of, perhaps what gold's, the biggest myth about it is, what would you say is its most unsung attribute? For me, is its simplicity. It's a very simple asset in my view to get around. What would you say is its most unsung attribute as an investment?
Gosh, I don't know. I sing all the praises of gold.
Let's say that people don't naturally kind of go, oh yeah, I appreciate that.
Every piece of electronic good and device that you have,
Yep.
your phones, your computers, the camera that's recording this this interview, depend upon gold. We hear a lot about how copper, silver, nickel, lithium, cobalt are all important battery metals or electrification metals, but don't underestimate gold. I mean, it's expensive. You don't generally want to use things in industrial processes that are charged in dollars per ounce. You'd much prefer dollars per ton.
Sure.
So where gold is being used nowadays, it's used because it's really necessary.
I was going to say, the fact that we're still using it kind of proves the point that it's valuable.
Absolutely.
Yeah. And look, that's a great segue then into something the World Gold Council released I think last year,
Yeah, it was
last
year,
18 months or so. Fantastic series called The Golden Thread, 4 or 5 short videos on gold's use across industry, which I think is just absolutely a real credit to the organisation for putting that together. What are some of the other initiatives the World Gold Council is up to now in terms of promoting gold investment and just sort of making the case for gold with investors out there?
Yeah, we're trying to do a number of things. We're doing quite a lot of marketing of gold itself, trying to get more people to be aware of why they should invest in gold, and also to get people to understand the World Gold Council a bit better. I call it the dinner party conversation question, because I want to, when I'm going out and meeting people for the first time and they ask me, who do you work for?
What do you do?
Oh, I work for the World Gold Council. I want them to say, oh yeah, I've seen your ads. Yeah, I know about all the stuff that you've been doing. And we've got a lot of work to do there. I think we've been a typically British understated organisation that has been almost a bit shy of talking about some of the things that we've done. And the organisation's done a lot in the last 33 years. And some of them within the industry we're well known for. For example, the development of the gold ETF market, and we're the sponsors of a couple of very big ETFs in the States. But we've also done a lot of gold market development in some emerging markets like China. We got involved with the Chinese government in 1999 and then again in 2001, writing detailed recommendations about how the Chinese could develop their gold market and open it up. Yeah, and look, it was only because the Chinese wanted to open up their gold market that we did this sort of work. But the reason why the gold market in China has a Shanghai Gold Exchange, has places where people can go and buy physical gold investment, is at least partly due to the recommendations we've made. And in the intervening period, the Chinese gold market's gone from about 200 tons to about 1,000 tons.
Yeah.
And you know,
Enormous.
I've been associated with, well, I've known of the World Gold Council since the late 1980s when it started. And I followed their data and everything for years before I joined the organisation. I found out so much stuff that we've done that we've never really spoken about.
Yeah, right. Interesting.
Yeah.
Interesting.
Hiding our talents under a bushel, as they say.
Fair enough. Now, look, just conscious of time, 2 more questions we'll hopefully do very quickly. The first one, and again, playing a bit devil's advocate here now, obviously rates are still on the move higher. There's an expectation that inflation will moderate going into next year across most of the developed world. You know, what's the 60-second case for gold in a portfolio today, right now?
Well, look, on a strategic level, it has been this contributor of returns to your portfolio over the last 5 years, 10 years, 20 years. It's got the diversification benefits I've spoken about. It's liquid. It's not as volatile as you think. And if you've had it in your portfolio, it's increased the risk-adjusted return. I don't know what's going to happen in the future. And I talk a little bit about Rumsfeldian conditions.
Known knowns
and exactly.
Sure.
Gold helps you in the unknown unknowns.
Sure.
If you think about COVID, nobody apart from Bill Gates had a coronavirus pandemic in his
model.
What to expect in 2020.
Sure.
Similarly, you know, we've seen geopolitical tensions rising, but you know, I don't think many people was expecting the biggest land war in Europe since the Second World War.
Sure.
And gold has protected your portfolio during those circumstances. I think the other thing is as well, at the moment, for all of the increases that we've seen in inflation, bond markets, particularly in the States, are telling you that they're giving the Fed the benefit of the doubt.
Sure.
5 year forward inflation expectations, about 2.2, 2.3%.
Yeah, it's non-existent or elevated.
Exactly. It's a bit higher than it was a couple of years ago during COVID, but it's certainly not elevated. That could change.
Yeah.
As I say, I have grey in my hair and I can remember high and protracted inflation. And if we get to a situation where central banks have to start cutting interest rates because of the damage that's being done to their economy, and yet inflation's still high, and it's not gone down to the 2%.
Back to 2, 3, 4.
Absolutely.
Yeah.
Then I think we're in stagflation or stagflationary conditions, and historically that's been a very good time for gold, both in absolute and particularly relative terms.
Yeah. Yeah, no, look, that makes perfect sense. One of the charts we look at a lot and you know, is this gap between current CPI and whether you use 5 years or 10-year break-evens, whatever. It's basically telling you the same story. That gap is almost unprecedented right now. So, you know, when we're talking to clients, we're saying, look, inflation could come down a long way, yet still be a lot higher than what the market's currently expecting. So you'd expect that to be bullish for gold if that transpires. And that's a nice little segue into our final question. Obviously, we're here in Australia. ABC Bullion's, you know, client base, very Australian-centric. Is there a particular message, you know, that you've got for Australian investors or gold in Australian investment portfolios worth sharing? Yeah,
we look at the effect of putting gold into portfolios around the world and over different timeframes. The one we start with is putting gold into a typical US pension fund portfolio, and you get a target allocation, an ideal allocation from the efficient frontier between 5 and 8%.
Sure.
Now, we replicate this around the world. Look at UK, Europe, Singapore, you name it. We've probably actually done the work on it. But the highest target allocation that we've come across is in Australia.
Is Australia, right.
So don't think...
And the number in Australia is typically around...
14 to 15% over the last 10 years. Now, we're actually, after having some conversations with investors over the last few days, they've given us a few suggestions about how we could potentially tweak that work. So it might move it a little bit, but it's not going to move very much. So what I would say is often people think because they're invested in predominantly Australian assets, they've got a lot of exposure to commodities and therefore gold anyway.
And de facto.
And they don't need to think about gold as a diversifier. Whereas all the evidence that we've come across is it's exactly the opposite.
Yeah, right. That's fascinating. So you almost, even though we're a big gold country, as it were, and lots of listed gold miners, the case for actually a distinct gold allocation within a portfolio is stronger here than other developed markets. Okay, look, John, I actually lied though. I do have one more question for you. Next Ashes series, Australia versus England. Who's going to win?
Australia, probably.
Score?
Where is it being played, actually?
I think it's here, isn't it?
If it's here, then I think that...
Actually, no, it's over there.
All right, okay, I'll change my mind then. I think we'll sneak it 3-1.
3-1.
Yeah.
When was the last time England beat Australia 3-1?
Oh, I don't know.
Yeah. Okay. Watch this space. We'll revisit that in due course.
Yeah, well, if you come across, we'll have to go along to one of the games. It'd be a lot of fun.
Look forward to it.
Cheers. Thank you very much.
Thanks, John.